Welcome to the deep dive. Today we're really getting into the weeds, trying to understand what's actually driving the market right now.
Uh-huh.
We've gathered some fascinating sources, everything from historical market data, some really deep stats, to expert analysis. Think of it as a shortcut to grasping this current bullish trend.
That's right. And our job today is basically to pull out the most vital bits of information from all this material. We'll look at some, frankly, surprising patterns from the S&P 500's history, stuff that might just make you rethink how the market behaves, and then we'll connect those dots to the bigger economic picture, including some forces that, well, don't get talked about nearly enough, but are incredibly powerful. So you get a much clearer perspective, not just on what's happening, but really why it matters for you and your portfolio. Okay. Let's dive in.
Yeah, let's do it. Let's kick things off with a statistic from our sources that I have to say genuinely caught my eye. It focuses on how the market performs in May. Seems there's a really compelling trend, almost predictive, you could say, when the S&P 500 has a particularly strong May.
It's fascinating, isn't it? The historical consistency is what's really striking here. The research we looked at shows that since 1950, there have only been 7 times, 7 specific instances, when the S&P 500 climbed more than 5% just in the month of May. And the most recent one, well, our sources point out it was just last month, May 2025, it clocked in with a pretty impressive 6.2% return for the month.
Okay, so a strong monthly gain, fine.
Yeah.
But what's the really consistent thing our sources found about what happens after these strong Mays, in the months, maybe even the year following?
Right, and this is where it gets potentially really insightful for anyone thinking longer term. The data points to consistently positive returns down the line. On average, after one of these Mays with over 5% growth, the S&P 500 saw average returns of, let's say, 1.2% after 1 month, 2.1% after 3 months, then it jumps to 6.4% on average after 6 months, and here's the kicker, an average of 19.9% after 12 months.
Almost 20%.
Exactly, but wait, here's the part that really makes you pause. Our source would highlight that the market was actually higher 100% of the time, a full 12 months later, in every single one of those 7 instances.
100%.
Yeah.
Historically, that's more than just a strong signal, isn't it? It suggests some kind of really deep-seated bullish momentum that, at least historically, has been incredibly reliable. How does that stack up against, say, just the normal average return?
Yeah, it puts it into perspective. If you look at the bigger picture, the S&P 500's overall average annual return since 1950 is somewhere around 9.2%. So a strong May, based on this historical data, not only almost doubles that average annual yield, but has, historically anyway, guaranteed a positive result 12 months later. It strongly suggests that when the signal fires, the underlying bullish forces are really truly in the driver's seat for the longer term. It's like the market saying, okay, half chosen, we're heading up.
That May statistic alone is pretty compelling. Makes you sit up and take notice. But you mentioned our sources dug up something even rarer, almost like a market legend. What happens when the S&P 500 doesn't just climb, but explodes? A massive 20% or more gain in just 2 months.
Yeah, this is genuinely rare territory, a market unicorn almost. According to the data we reviewed, this has only happened 6 times. 6 times since 1950. And the most recent instance, it was marked on June 9th, 2025. The index had posted a staggering 20.5% return over the previous 2 months. You can just imagine the kind of, well, buzz, maybe even disbelief that kind of surge creates.
Absolutely. So what does history tell us follows that kind of explosive, really rapid-fire surge? I mean, does that kind of intensity usually mean things cool off quickly, or does it fuel even more momentum?
Well, surprisingly, the historical pattern suggests even more momentum. The average returns following these surges are, frankly, remarkable. We're talking 8.2% on average in just 1 month after the signal, then 12.5% after 3 months, 16.3% after 6 months. Oh, hold on, an astonishing 30.8% average return after 12 months.
30%. Wow.
And here's the really crucial part, again emphasized in the sources. In all 6 of those historical cases, the future returns across all those time frames, the 1, 3, 6, and 12-month marks, were 100% positive every single time.
Okay, so let me get this straight. The 12-month return after that signal averages nearly 3.5 times the S&P 500's typical annual return. And it's been positive every time it's happened. What does that suggest for someone trying to figure out where the market might be heading now?
It suggests a really powerful underlying bullish inertia, doesn't it? I mean, this consistency of positive returns after such huge short-term gains gives us a pretty solid historical lens. It implies that these kinds of explosive moves historically haven't been precursors to a crash, but rather signals of continued strength. Now, obviously, past performance is never a guarantee.
Right, the standard disclaimer.
Exactly. But these patterns, they do offer a unique way to look at what's happening now. They remind us that sometimes these really powerful surges are actually signaling deep, perhaps lasting bullish trends.
Okay, so these statistics paint a very, very positive picture, almost overwhelmingly bullish based on history. But our sources also get into nuances, right? They detail the specifics of what's happening right now. What are experts saying about the actual nature of this current trend? Is it really as strong across the board as those big index numbers might suggest?
That's a great question. And yeah, the sources definitely dig into that. They confirm, yes, there's a strong bullish trend. But one interesting driver they point to is psychology, specifically FOMO.
Fear of missing out.
Exactly, fear of missing out. Apparently, after the market went sideways for quite a while, any little dip now isn't seen as a red flag. It's viewed as, a buying opportunity. So this eagerness, this rush to jump in and not miss the gains is actually a significant force helping to push things up.
So investor sentiment is a big part of it. But interestingly, the sources also mention that while the S&P 500 and the NASDAQ are hitting new highs, maybe the rally isn't quite as widespread as you'd think. What does that concentration look like? What stands out there?
Well, what's really fascinating is exactly that concentration you mentioned. Despite the headlines about new index highs, our sources show that actually only 22 stocks within the S&P 500 are currently at their own historical highs. Just 22.
That few.
Yeah. It tells you just how much weight those big tech names, the ones often called the Magnificent Seven, Apple, Microsoft, Amazon, Google, Meta, Tesla, NVIDIA, how much they're really driving the index performance. Meanwhile, other big companies, even some big tech names outside that group, have been surprisingly flat. So it's definitely not a case of a rising tide lifting all the boats equally.
And I guess you see that even more clearly if you look beyond the S&P 500, right, at other indices. What did that tell us about the broader market health?
Precisely. You look at something like the Russell Index, which tracks smaller companies, and our sources say it's lagging significantly. It's nowhere near its historical highs. That kind of divergence really highlights that different parts of the market are telling different stories right now. And another key thing the sources brought up, something easily missed, is currency impact. Like if you invested in the S&P 500 this year, but you're converting back to, say, euros or yen, your return might have been almost zero because of currency shifts. But flip that, if you invested in European stocks, the Euro stocks using dollars, you might have seen returns closer to 20%.
Wow.
Yeah, it really underscores how crucial it is to think about currency effects, especially for international investors.
That's a really important point, often gets lost in the shuffle. Okay, shifting gears slightly, what about interest rates? The market narrative seems pretty set on rate cuts coming. Do our sources buy into that optimism?
Well, the sources suggest the market has definitely increased the odds it's pricing in for rate cuts, maybe in July and perhaps more likely in September. But there's also a healthy dose of skepticism noted. The experts cited seem to think any actual cuts are going to hinge very heavily on the upcoming inflation numbers. The Fed keeps saying they're data-dependent, right? And the sources echo that don't expect cuts unless the inflation data really supports it.
Makes sense.
And just quickly, from a technical standpoint, for the S&P 500, the sources flag some key levels, resistance kind of a ceiling around 6,255, and support a floor down around 6,162. Those are the levels traders are watching closely right now.
Good to know. Okay, so we've got these powerful historical stats. We've got the current market picture, strong but maybe narrow, driven by tech and FOMO. But the sources also push us to look even deeper, asking a really fundamental question. How is the market hitting these highs when there's so much negative news? Conflicts, geopolitical tensions. What's the real engine here beyond the stats and sentiment?
This is where the analysis gets, well, pretty provocative. Our sources put forward a theory that the main, perhaps the undeniable driver, isn't earnings or traditional economics, but the relentless growth of U.S. fiscal deficit and public debt. I mean, the numbers are staggering. National debt is pushing nearly 97% of GDP. Last year alone, the deficit added over $3.6 trillion. And get this, the interest payments on the existing debt now cost more than the entire defense budget. That's a huge chunk of federal income just servicing debt.
That's quite something. So how is the government handling this? I mean, financing this enormous growing debt.
Right.
And what role do the sources say the Federal Reserve plays?
Well, the strategy, according to the analysis we read, is basically trying to outgrow the debt, keep the economy expanding faster than the debt pile grows. It's a bit of a race, and they finance it by issuing government bonds, lots and lots of bonds. These get bought by different players, other countries, pension funds, banks, and crucially, the Federal Reserve itself.
Right. And the Fed,
Yeah.
they can basically buy as many of these bonds as needed, right, by essentially creating new money.
Precisely. That's the core mechanism highlighted. The Fed has the capacity to effectively create money digitally to purchase these government bonds, financing the government's borrowing. And this, according to the sources, leads to what they call an artificial flooding of the financial system with liquidity, with new money. This money doesn't just vanish, it flows into the economy, and a significant chunk finds its way into financial assets, like stocks.
Okay, and this connects to that idea of smoke screens you mentioned the sources talk about.
Yeah.
That sounds intriguing. What's the claim there?
Yes, it's a bold hypothesis. The sources suggest that all the noise, the headlines about wars, conflicts, political drama, while obviously serious issues, might also serve, perhaps unintentionally, as a kind of smokescreen,
Hmm.
distracting attention maybe from this underlying reality, the massive ongoing expansion of debt and the continuous injection of liquidity into the markets by the central bank. The core argument presented is that this liquidity, this monetary stimulus, is the fundamental force keeping the stock market bullish, almost regardless of the news cycle. So, negative news might cause temporary dips, maybe short-term losses for people betting against the market, but the underlying liquidity pressure eventually pushes things back up. And this trend, they suggest, could well continue at least until the U.S. congressional elections coming up around November 2026.
So if this liquidity injection is relentless, what are the wider consequences for the average person, for the value of money itself?
Well, the direct consequence highlighted is a gradual diminishing of the dollar's purchasing power over the long haul. It's not always immediate, visible inflation everywhere, but more like a slow erosion. And in that kind of environment, the sources argue real, tangible assets, things like solid companies with pricing power, gold, silver, even real estate, tend to increase in value over time. They act as a sort of hedge against that currency devaluation. You can even see it reflected, they say, in things like the falling dollar index, the DXY. It mirrors this government debt situation and the monetary stimulus, and that weakness in the dollar, in turn, can actually help push asset markets like stocks higher. It's all interconnected.
Okay, so quite a journey today. Let's try and wrap this up. We started with some pretty incredible historical patterns, right? The S&P 500's strong track record after a big May.
Right, and that even rarer, but historically perfect signal after a massive 2-month surge, both pointing to 100% positive 12-month returns in the past.
Yeah, amazing stats. But then we also got into the nuances of this rally, how it's really concentrated in a few big names, the Magnificent Seven.
Exactly. And perhaps the biggest takeaway, the underlying driver discussed in our sources, the potentially overlooked but massive role of growing public debt and the resulting monetary policy, the liquidity that's constantly being pumped into the system.
It's definitely a reminder that what you see on the surface, what makes the headlines day to day, often isn't the whole story, is it? The market isn't just reacting to earnings reports or economic data in a vacuum. It seems to be heavily influenced by these deeper structural forces, liquidity, debt, government financing, creating this persistent upward pressure.
Indeed. And that leaves us and you with a really interesting question to ponder, doesn't it? If the market is being driven so powerfully by this underlying liquidity, this debt-fueled stimulus, how does that change how we should even think about value? Does traditional valuations still apply in the same way?
Yeah.
And what new opportunities or maybe new risks does that create for you as you think about your investments for the long run? Definitely something to mull over until our next deep dive.